Looking for a great deal on one of the best dividend aristocrats out there? Want to own shares in a company so serious about paying monthly dividends that it trademarked its own moniker? Like the idea of buying stock after a 16% drop in its price? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a real estate empire. Location, location, location. The famous phrase about real estate. Well, how about scale, scale, scale? Because scale matters very much. And if you're trying to scale up in real estate by yourself, that requires a lot of work, capital, and risk. Investing in this company gives you instant scale, and this company sends you a monthly rent check without you doing any of the hard work. Plus, this company continues to grow its revenue, profit, and dividend like clockwork. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explained exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Realty Income Corp, which appear to be trading at a significant discount today. Realty Income Corp, stock ticker O, is a real estate investment trust that leases freestanding, single-tenant, triple-net leased retail properties. Founded in 1969, it's now a $39 billion by market cap real estate titan that employs nearly 400 people. Their portfolio of over 11,700 properties is diversified across the US, Puerto Rico, Spain, and the UK. The company serves more than 1,100 clients operating across 79 different industries. As of the end of September 2022, the property portfolio has an occupancy rate of 98.9%. Real estate is great. Like the old saying about land goes, they're not making it anymore. Other than small reclamation projects, the usable land we have now is all we'll ever have. And those who can leverage this situation by putting up highly profitable properties on the limited land set themselves up to prosper. If you can secure well-located properties, then rent them out to willing and able tenants, you've got yourself a cash cow. However, this is easier said than done. Real estate isn't so great in the sense that it's extremely difficult, expensive, and time-consuming to actually do this. Becoming your own landlord involves scouting, lining up financing, studying comps, closing leverage, finding tenants, managing properties, etc. And that's not even getting into how hard and risky it is to scale this on your own. Enter Realty Income. When you buy shares in Realty Income, you instantly own a slice of a heavily diversified portfolio of commercial properties that already have paying tenants installed. You get to become a scaled-up landlord without doing any of the heavy lifting. None of the broken toilet phone calls at midnight. Realty Income handles it all for you, all while sending you your dividend check every month, which is steadily rising every year. What's great about Realty Income's business model is the nature of a commercial triple net lease. It's a lease agreement on a property whereby the tenant agrees to pay all the expenses of the property, most notably including real estate taxes, building insurance, and maintenance. This greatly reduces Realty Income's overhead. Moreover, Realty Income leases its properties to some of the most well-capitalized and successful tenants a landlord could possibly hope for. Their top tenants include the likes of Dollar General Corp, stock ticker DG, and FedEx Corporation, stock ticker FDX. Diversification across tenants, industries, and geographies, and maintaining a high level of quality sets Realty Income up for continued prosperity. That means growth across its revenue, profit, and dividend. To date, the company has increased its dividend for 28 consecutive years. Yes, Realty Income is an esteemed dividend aristocrat. In fact, it's one of the few dividend aristocrats that's a REIT. The 10-year dividend growth rate is 5.3%. Not huge growth, but the reason to own a slice of this business is right in its name. It's all about income. Indeed, the stock yields 4.7%. And it's not just income, but monthly income. Realty Income pays its dividend monthly, which is akin to collecting a monthly rent check. Realty Income is so known for this, in fact, it's actually trademarked the moniker, the monthly dividend company. This yield, by the way, is 40 basis points higher than its own 5-year average. With a payout ratio of 73.8%, which is quite reasonable for a REIT, we have what appears to be a well-covered dividend. A dividend aristocrat that's paying a large monthly dividend is something that's hard to not love. Looking at business growth, Realty Income moved its revenue from $485 million in fiscal year 2012 to $2.1 billion in fiscal year 2021. That's a compound annual growth rate of 17.7%. This is obviously very impressive at first glance. However, we have to remember that REITs fund growth via debt and equity issuances. Furthermore, Realty Income's recent merger with VEREIT moved up revenue in a meaningful way. With a REIT, you really have to look at profit growth on a per share. Basis. And when assessing profit for a REIT, it's imperative to look at funds from operations instead of normal earnings. Funds from operations is a measure of cash generated by a REIT, which adds depreciation and amortization expenses back to earnings. Realty Income grew its funds from operations per share from $2.02 to $3.39 over this period, which is a compound annual growth rate of 5.9%. This number, which is certainly very solid, is a more accurate reflection of Realty Income's growth profile. Noticeably, we can see that dividend growth and funds from operations per share growth lined up really well over the last decade, showing just how prudent and thoughtful management has been. Looking forward, CFRA currently has no projection for Realty Income's funds from operations per share growth over the next 3 years. This is a shame, as I do like to compare the proven past up against a future forecast. That said, we can draw some reasonable conclusions in other ways. CFRA does estimate fiscal year 2022 funds from operations per share to come in at $4.04, and their estimate for fiscal year 2023 funds from operations per share is at $4.13. This is supported by Realty Income's own fiscal year 2022 guidance, which calls for $4.03 in funds from operations per share at the midpoint. This kind of bottom line growth would represent a very nice acceleration in growth off of the historical mid-single digit level. Some of this does have to do with the sizable VEREIT acquisition, which should improve Realty Income's growth and resiliency. Regarding this, CFRA notes the following, and I quote, "We also think Realty Income's resiliency to a slowdown in consumer spending, possible given current high inflation, rising interest rates, and geopolitical risks, is underestimated by investors. The company has a long history of high occupancy rates along with stable, growing dividend payments. We believe the recently completed VEREIT merger, increasing Realty Income's enterprise value to $57 billion, will help to increase economies of scale while further reducing its exposure to theaters," unquote. The broadening out of the property portfolio is an important point, which CFRA notes again here, and I quote, "Realty Income's tenant diversification has also improved, with their top 10 clients accounting for 27.6% of annualized rent in Q3 2022, down from 28.1% in Q2 2022 and 29.4% in Q4 2021, unquote. And this improvement has also bled down into occupancy, which CFRA illuminates here, and I quote, "Occupancy remains strong in Q3, but flat quarter over quarter at 98.9%, still the highest occupancy in 10 years, while Realty Income's releasing recapture rate was a healthy 108.5%. We forecast occupancy will remain above its historical average of 98% into 2023 due to the company's desirable property locations and high non-discretionary retailer demand," unquote. I want to expand on this occupancy point just a bit. Realty Income ended fiscal year 2019 with 98.6% portfolio occupancy. Realty Income's current occupancy rate is 98.9%. The stock was approximately $80 in early 2020. The stock is now approximately $63. Realty Income has gotten better in almost every possible way over the last 2.5 years, with higher occupancy being another key piece of evidence of this, but the stock has fallen by 20% over that period anyway. If that kind of disconnect isn't advantageous, I'm not sure what is. Currently, interest rates are rising in an effort to curb demand and fight inflation. While rising rates harm the firm, many of the long-term contracts have rent escalators built right in. Plus, inflation makes the existing real estate portfolio that much more valuable and difficult to replicate. decade. I believe Realty Income is still quite capable of producing its 5% plus annual dividend growth rate, with some higher than average dividend raises quite possible over the next few years. With the stock starting yield at nearly 5%, this kind of setup should be especially compelling for income-oriented dividend growth investors. Moving over to the balance sheet, Realty Income has a rock-solid financial position. The REIT has $43.1 billion in total assets against $18 billion in total liabilities. Realty Income's credit ratings are well into investment-grade territory: A3 Moody's, A- S&P Global. Moreover, many of the company's top tenants have their own investment-grade credit ratings. Realty Income's combination of triple net leases and a diversified roster of top tenants has led to one of the best track records in all of commercial real estate, and the company's deep expertise, long-term contracts, and massive scale give it durable competitive advantages. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. Real estate demand is cyclical, and the financial health of its tenants could sour in a prolonged recession. A REIT's capital structure relies on external funding for growth, which exposes the company to volatile capital markets and interest rates. Higher interest rates can hurt the company twice over. Debt becomes more expensive, and equity can become more expensive because income-sensitive investors have alternatives, which pressures the stock. A recession can also hurt the company twice over. Demand for real estate can cool, and equity issuances after a drop in the stock's price would come at a higher cost. Any wholesale changes in physical retail could hamper long-term growth. The company's scale is an advantage, but it also introduces questions around growth and the law of large numbers. I see appreciable risks here, but I see those risks as part of a very attractive total package, and the stock's 16% drop from its recent high has made this total package look even more attractive by virtue of the valuation. The stock is trading hands for a forward price to funds from operations ratio of 15.7 based on this fiscal year's guidance. This is analogous to a PE ratio on a normal stock, showing just how low the valuation has become. Also, the price to cash flow ratio of 16.2 is well off of its own 5-year average of 19.7. And the yield, as noted earlier, is noticeably higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 5.5%. This kind of growth is at the low end of what I ordinarily allow for, but this kind of expectation is quite reasonable in my view. The company's demonstrated bottom line and dividend growth over the last decade have both been in excess of 5% annually. Recent guidance indicates an acceleration in bottom line growth off of its base, and the payout ratio remains flexible enough to allow for dividend growth to at least track bottom line growth. However, the company's size may start to work against them, interest rates are on the rise, and a US recession could be in the offing. Overall, I do believe Realty Income is highly capable of growing the business and the dividend at this undemanding mid-single-digit rate over the years to come. The dividend discount model analysis gives me a fair value of $69.86. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Realty Income as a 5-star stock with a fair value estimate of $78. CFRE rates Realty Income as a 4-star buy with a 12-month target price of $70. I landed within pennies of where CFRA is at on this one. Averaging the three numbers out gives us a final valuation of $72.62, which would indicate the stock is possibly 15% undervalued. Here's the bottom line, guys. Realty Income Corp has built up a high-quality real estate empire with impressive scale and diversification. Its structure reduces both overhead and risk, and it positions shareholders very favorably. With a market-smashing yield, mid-single-digit dividend growth, nearly 30 consecutive years of dividend increases, a flexible payout ratio, and the potential that shares are 15% undervalued, long-term dividend growth investors looking for a monthly dividend from a reliable Dividend Aristocrat should definitely have this name on their radar. And now for a special news announcement. Celsius Holdings Inc., stock ticker CELH, just posted a blowout Q3 report with 126% year-over-year revenue growth and 122% year-over-year gross profit growth. This is looking really good for PepsiCo Inc., stock ticker PEP, shareholders. PepsiCo earlier this year inked a distribution deal with Celsius, which also saw PepsiCo invest $550 million into Celsius for preferred stock, equivalent to an estimated 8.5% ownership in Celsius on an as-converted basis. We've covered PepsiCo numerous times on the channel, highlighting it only months ago as a fantastic inflation fighter. PepsiCo just keeps getting better. Don't forget about it. Thanks so much for watching. Hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It'll allow me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.